My name is Mark LaMonica. I'm the product manager for Morningstar Premium and morningstar.com.au. We are going to talk about investment risk today. And we already have a comment from Amy saying, thanks again for doing this. That's nice. Thank you. So before we get started, a couple housekeeping items. So anything you hear today, and Ray says, happy birthday, Will. Look at that. Couple housekeeping items. Anything you hear today is general advice. If you want, I'm trying to remember this New Zealand one now because I didn't write it down. If you want any specific advice, you should go talk to a financial advisor. And if you'd like to see our New Zealand disclosure statement, you can go to our website, morningstar.com.au. There we go. I did it. It'd be great if people ask questions today. That'll make it entertaining. And you can say happy birthday to Will if you would like. Will said that he got a hedge clipper for his birthday. Edge trimmer. He got an edge trimmer for his birthday, which sounds really boring. Really boring. But Will has envy about his neighbor's grass. And now that he has the tools, he can do whatever it is that makes nice grass. Anyway, clearly I do not live in a house with grass. Let's talk a little bit about risk today. So one other thing. On Tuesday, we are doing how to value a share. It'll be fun. There'll be spreadsheets. Then we're going to take a one-day break. So we'll be off next Thursday. Then we'll be back with a new series the week after that. So if anyone has any ideas, send them over to me at mark.lamonica1@morningstar.com. So any topics you'd like to cover, and we can get to those. All right, here we go. Will is typing an answer to the birthday wishes, so that's nice. All right, so we are reducing investment risk in your portfolio. All right, we're going to talk about a number of different risks today. Inflation, concentration, sequencing, longevity, and market risk. But I put in this box at the bottom of the screen, not reaching your goals. So with all investors, what is the biggest risk we face? Well, the biggest risk we face is not reaching our goals because we're all investing for a reason. So it's important, and we'll put all of these different risks within that context because that's what we're all trying to do here, accomplish a goal, whatever that is. So let's get into this. So we will start with inflation risk. So I think everyone knows what inflation is, so we don't have to spend a lot of time talking about inflation. But yeah, at the end of the day, it's obviously that money's purchasing power generally erodes over time. So as investors who are investing for the future, we need to be very cognizant of inflation. So let's talk a little bit about inflation. And the number that, of course, is important to us is our return after inflation. So there are a couple different considerations with inflation. Number one, that inflation is measured, of course, with a basket of goods, and that's a basket of goods that the government goes out and measures the price of, and then that, of course, equates to inflation. But it's important to remember your own personal inflation. That's what's important. We all have different circumstances. We all have different percentages of our income that go to different things. So it's important to spend some time thinking about your own personal inflation. So an example that I guess is pretty easy to use is that if you own your home outright, you probably have a very different inflation, a housing inflation situation than if you were a renter of an apartment and you're at the whims of the market. So that's an example. So let's talk about the impact that inflation has on different types of investments. So, and I think it goes without saying that inflation has been very low for a while. The last kind of general global inflationary spike there was in the kind of late 70s and into the 80s. And then with pretty substantial rises in interest rates, central banks globally were able to knock inflation down. Hasn't really come up in any sort of aggressive way since then, but still, every year a couple percent of your purchasing power, of course, is being eroded. So take that into account when you're making goals. But let's talk about how inflation impacts different types of investments. So number one, obviously, if you just keep all your money in the bank, inflation is going to be a problem, especially nowadays that you're getting almost no interest. So inflation is certainly running at a higher rate than you were getting in interest from a bank account. So something to think about. The other thing is, of course, around fixed income. So with fixed income, well, everyone's laughing. So somebody must have. Oh, okay. We'll get to the questions in a second. That's like an essay. It's like a paragraph. But if you invest in fixed interest, of course, inflation is also not your friend. So if you go out and purchase a bond for 10 years, 20 years, 30 years, whatever it is, you're, of course, locking in a certain coupon rate on that bond. So inflation will obviously eat into your returns. There are inflation protection bonds. But that's a whole different story. So if someone has a question about those, we can answer them. Finally, with stocks. So if you are investing in shares, you have a lot better shares have a lot better way, obviously, of dealing with inflation because they're based on companies. And companies, as long as they're able to raise prices, at least at the inflation rate, then they, of course, can pass along those additional profits to you. But when we're thinking about investing in shares, different sectors and different types of companies can be impacted by inflation in different ways. So we talked about moats on Tuesday. And that, of course, is a sustainable competitive advantage. So part of that, of course, is being able to maintain your margin, which means you do have pricing power. And you can hopefully continue to raise prices with inflation. But then the other side of inflation, of course, companies have expenses. So if there are inputs, particularly sort of natural resource inputs into a company, that could be a problem if there's inflation. And then, of course, people that invest in real assets generally think that they can use those as inflation protection. So that's inflation with shares. But at the end of the day, the biggest risk, obviously, you're facing is not taking into account as an investor. So whenever you are setting goals, and if you go back and watch our goal setting episode, make sure that you're taking inflation into account when setting your goals, because that can be a big mistake if you're looking at a long time horizon out to retirement or something like that. Okay, moving on. All right, we're going to look at diversification, but we're going to look at it a little bit of a different way. We're going to talk about concentration risk. So this is the chart that I haven't done this one in a while, but this chart is a problem for me because I'm colorblind. So this thing's just like a disaster. But anyway, we'll get to the chart in a second. So let's talk about diversification. I added that quote from our good friend Warren Buffett. Diversification may preserve wealth, but concentration builds wealth. So what does that mean? It means that you can potentially be overly diversified. So let's take two different scenarios here. So one scenario is that if you are an equity investor, you buy one stock. You put all of your money into one company. So that, of course, that's not diversifying a lot. The other scenario, of course, is that you buy every single share that's available in the market. So what are the two differences between that? In one, you are guaranteed to get the average return, right? That's what indexing is. So passive investing through an index is you're guaranteed to get the average return minus fees. If you buy one share, you have the biggest chance for the greatest return because maybe this one share that you purchase would be the best performing stock in the entire market. But of course, you also have a good chance that you are going to lose all of your money. So the goal with diversification is to pick a sweet spot where you are not so diversified if you are investing in individual shares or any sort of active manager. You're not so diversified that you're actually just paying active prices for the entire market, but you also have enough diversification so that individual risk to a company is removed from your portfolio. It's obviously not completely removed, but removed to a certain extent. So that's what we're talking about with this concentration diversification risk. And what this chart shows is, if you know what colors are and are not me, you'll see that every year, basically, we have different combinations of colors. And what we've done is we've taken all of these different asset classes along the bottom of the screen, everything from cash to international equities, and they have simply been ranked by what was the top performing to the lowest performing asset class. And the fact that this chart almost looks random is an indication that for the most part, returns are very, very different every year. What performs well, what doesn't perform well. So this is another reason that we want to build a diversified portfolio that does have exposure to different asset classes. But within those asset classes, of course, we do need to take on a little bit of concentration if we want to actually beat the market, if that's your goal. All right. Okay, so we've got a question on this. From your examples, looks like it's best to keep cash, negative 2.5%, bonds, shares. I do not understand the question. So I'm sorry, I'm a little bit slow today. It was my birthday yesterday, and what did I do? Yeah, it was my birthday yesterday, and I did not get a edge clipper. I consumed most of my birthday in various venues. So I'm not sure exactly what the question is, but all this is supposed to show you is that different asset classes perform differently every single year, and that's why you do want wide exposure. That's why we want to build a diversified portfolio with different asset classes that have different risk and return profiles and then different drivers of return. So sorry that I'm too brain dead to answer that question. All right, we're going to talk about sequencing risk. So sequencing risk is pretty exciting. Actually, I took some notes and I missed something. We're going back in time. All right, so this is the one point I wanted to make that we did not talk about. So what are you trying to do when you're diversifying within each one of these asset classes? So what you're trying to do is diversify the unique risk, as I started to say, of an individual company. And that's what we're trying to offset by diversification. What we are not diversifying away from, of course, is systemic risk. So systemic risk is just the market risk that we are taking on as investors. And remember that the market risk that we're taking on, and that can be anything that could impact the market. In this case, we're looking at negative impacts, but it could be anything that impacts the market overall. So basically every single stock that is out there. So falling markets, rising markets, et cetera. So we're not trying to diversify that away because that is what we actually get compensated for as investors for a return, right? So you're not getting the reward without taking some risk. So when we go out to asset classes that are riskier, so they're more volatile, your expected returns are higher. So just something important to remember when we're going through this. And what does that actually mean in terms of diversifying within each one of these asset classes? So there was a study that was done that suggests between a portfolio between 12 and 18 stocks diversifies away 90% or so of this unsystemic risk. So the risk associated with a individual company. So anyway, that's what I wanted to say. See, look, Will, Ray said happy birthday to me as well. So what do you think about that? See, you're not that special, Will. All right, we're going to talk about sequencing risk. So sequencing risk is the risk that depending upon, so of course we're looking at average returns, so we're all going to get average returns over a time frame, but sequencing risk looks at the timing of those returns. So basically, if you are about to retire or just started retiring, if the markets fall a lot, that is a problem for you. So that's what we worry about as we're approaching retirement, that it doesn't really matter what our average returns are. Of course, it matters what our average returns are, but it also matters when we get those returns, when we start retirement. And the reason for that, of course, is if you are, I don't remember what I turned yesterday, I think 28 or something like that. If you're 28 and you have a very long time horizon, if the market's too badly for 5 years when you're in your early 30s, it doesn't really matter at the end of the day. But as you retire, all of a sudden you are not contributing to your portfolio anymore. You're starting to pull money out. And if you have really bad markets, that can be a problem. And we've got these two different examples from Perpetual. So Shani used to work at Perpetual and she made this slide. So, and I think she still wishes she worked at Perpetual. She keeps having conversations with them, but swears she's not interviewing for anything. But these two slides show those examples. So what it shows, of course, is what happens if you actually lose money and what it takes to get that money back. Right? So we can see on both sides, what happens if you incur a loss of 20%? Well, you need a 25% gain to get it back. you lose 50%, you need 100% gain to get it back. So think about how difficult that is to do right as you retire and you're pulling money, you're starting to pull money out of your account. So now you need an even higher return than somebody who's contributing back in, or who's still contributing to your account, because of course you have less principal. So that's sequencing risk. We are moving quickly. Will's excited. He's got big plans tonight. I know you don't, Will. I know you don't. He's probably gonna. Yeah, exactly. He's gonna edge his lawn. Another wild night with Will. We took Will out. Shani and I took Will out for drinks a couple weeks ago, and then he got in a lot of trouble. So he's not allowed to go out with us anymore. Still in trouble, he says, even though I told him it was a mandatory work event. And I said, that's the excuse. So if I ever run into Will's partner, she will murder me. All right, longevity risk. So once again, we're talking about a retirement risk here. And once again, we have a chart from Shani's dream employer, Perpetual. I know you left, but you keep talking to them. I don't know why. I think you want to go back. If there's anyone from Perpetual on here, leave her alone. We would like to keep her here. So what we're looking at here is we're looking at two different scenarios where people die at different times at the end of the day. So the biggest risk that you have going into retirement is, of course, the fact that you don't know how long your retirement's going to be. And life would be a lot easier if we all knew when we were going to die. I guess it would be a lot harder if we were going to die young, but still, life would be a lot easier if you knew when you were dying in terms of planning for investing. So what do we do about longevity risk? Well, one thing that we do about longevity risk that ties into this last slide we're on, sequencing risk. So how do you protect yourself from sequencing risk? Well, as you approach retirement, of course, you change your asset allocation. So you are going to shift more funds into asset classes that have lower volatility. So whether that's cash or fixed income, that's what you want to do. So that means that if there is a big stock market drop right as you retire, you're protected more from that because simply you have less assets in the stock market. But the problem is you need to worry about longevity risk. So especially now that people are living longer, you can't go into too conservative of a portfolio because you still need the portfolio to support you for a long time. Now, this chart right here is basically showing us the same issue as we had before with sequencing risk, and it's just looking at the longevity side of it. So each investor started with $100,000 of savings at 45. Contributed $10,000 a year, and everyone got the same average return. So you think, great, both got the same average return, doesn't matter. The problem is, to achieve that average return, they had different sequencing of losses. So one person lost 15% immediately, right at the age 46. The other one happened at 64. And look at the difference between using the same drawdown, so taking the same amount of money back. Look at the difference of when they ran out of money, right? So this person ran out of money at 85, which is a real problem if you are not dead before you're 85. This person made it into their 90s. So this is what we're talking about with longevity risk, why it's important to keep money invested in equities even when you're in retirement, and also why sequencing risk, what the impact of sequencing risk can have. All right, I think this concludes the perpetual part of, is this from Perpetual too? Okay, so thank God. Shani found a slide that's not from Perpetual. There's a guy that keeps emailing me saying, when is Shani going to come back on the webinars? And I keep saying to Shani, when are you coming back on the webinars? And she just ignores me. I don't know why you'd leave this job. She tells me what she does. So I don't know what's better than this. All right, we're going to look at market risk and how this actually impacts your portfolio. We're going to look at the different parts of market risk and talk about what you can do about them. All right, so we'll start with exchange rate risk. So exchange rate risk, of course, is also called currency risk. And that's just the notion that, of course, wow, I'm getting notes from the peanut gallery. So that, of course, just refers to the fact that many companies now are global in some nature. So, of course, there is direct currency risk when you are investing overseas. And we cover that in our international investing one, and we can go through that if someone else wants to talk about it. But it's also just thinking about there are inherent exchange rate risk involved in all sorts of different companies that either sell things overseas, no matter where they are based, or they have inputs coming from overseas. They're buying things from overseas. So that is something we need to deal with as investors and be cognizant of. And of course, the other side of that, of course, is revenue, right? So revenue that companies make in international markets is getting translated back into the home market, even if they don't move the money. Even if they don't move any of the money, you're still having to translate those back in the financial statement. So something that we need to be aware of. So of course, with directly investing overseas, we talked about this in the global investing webinar, that if we want to use ETFs or funds, we can do that and get hedged versions of it where currency risk won't impact us. And then companies, you hope, are making that are also hedging certain activities. So whether they are hedging things, currency that when they need to acquire things overseas as inputs, or of course hedging sales that they have going forward. But over time, you can only hedge something for so long. Over time, if there are wide scale changes in currency, in exchange rates, that's going to impact companies. So something to consider as an investor. Same thing with commodities. So in Australia, we always think about commodities in terms of exporting those commodities. So that's of course great, but there are also a lot of companies, including companies here, that need to purchase commodities to basically do whatever they're doing. So there are commodity inputs into things that they're producing, and that's a risk we have to worry about as well. Like Will needs to, is this electric? Is your edge trimmer electric? Or do you put petrol in it? Okay, so Will needs to worry about this, that if there is a huge increase in petrol prices, maybe his lawn of his dreams is, not going to happen. But commodity risks are certainly something that we need to look at from an investor standpoint. And commodities also, if we go back to that inflation risk, commodities can also be a good investment in an inflationary scenario. So generally, real assets and commodities will go up in price as well. All right, interest rate risk. So interest rates. We hear a lot about interest rates. Interest rates, as I was talking about earlier, have come down significantly from the 80s. What that has done is, of course, it has driven a lot of asset returns. So directly from bonds, because, of course, bonds move inversely to interest rates. So when interest rates go down, bond prices go up. So that's good if you're a bond investor. Equities are worth more with lower interest rates just because of the way that we value equities, right? We're projecting cash flows into the future, and then we are discounting them back to the present day. One of the parts of that discount rate are, of course, interest rates. So interest rate risk, I would say right now, is probably pretty significant for all of us as investors, because any increase in interest rates is going to hit the market pretty hard, no matter what you're investing in. So that's interest rate risk. Of course, also flows through to the companies that you're investing in. That's why we want to look at companies' debt levels. We want to look at the term structure of those debts. When are they actually due? Are they fixed? Are they floating? But interest rates are something important to look at. And then, of course, we get to the last one, which is just equity price risk. So that's volatility. So volatility can be very critical at certain points in your investing career, especially if you are about to retire or just into retirement. But volatility in general shouldn't worry us if we have a very long time frame. Just make sure that when we have that behavioral episode, that it doesn't cause you to do anything that is not smart. All right. Our last slide. Did you make this slide, Shawnee? You've got like stuff written over other things? I must have changed the settings, yes. Well, at Perpetual, they probably don't allow you to blame your coworkers when you do something wrong, right? She's going to quit today. So how do we deal with all of these different risks? We, of course, diversify. And what we have at Morningstar is we do have 5 different strategic asset allocations that are parts of premium that you can see here. And really, we divide up between growth assets and defensive assets in each one of these. And you can see what the allocation is to each one of these different asset classes. As you get more aggressive, you are going to get more volatility, but the risk, it's hard to read because I screwed the slide up. The biggest risk, of course, that you have, investors, that we're going to bring all this back to, is that you don't achieve your goals. And what that means is that your investment strategy and your asset allocation choices are not appropriate for your goals. So that's why we go through this whole process of setting goals and having that be the input and looking at the required rate of return we need and having that be the input into our asset allocation and then finally our investing. Wow, that was very quick. So if you have questions about anything or about Will, send them through. Or if you have suggestions of places Shani should send her resume. Okay, so Amy's written this very long question. So I'm actually going to have to spend a second reading this. So Amy followed the suggestions about building a portfolio in line with her goals. The podcast and video, that's Investing Compass, Madagascar's hottest podcast. We are huge in Madagascar. And Amy would like to build a portfolio based on the aggressive percentage allocations. That's what we just showed. Wow, this is shocking that somebody has listened to us, Shani. What do you think? Okay, so she asks, wouldn't I be better to invest in one of the iShares core aggressive allocation ETFs and Vanguard diversified high growth ETF that already contains approximately the same allocation of Aussie equities, global equities, et cetera? Yeah, I think that would be a great idea. So one of the issues, of course, is there are transaction expenses when we do things. So if you can find a specific ETF that is multi-asset class, then yeah, that's a great approach. But hopefully, Amy, the process of going through setting up your goals and looking at what you want to accomplish has led you to come up with the fact that you need an aggressive portfolio, given whatever your goals are. So hopefully going through that process informed the choices you were making with asset allocation. Sounds like it did. And then you realize that, okay, now you've got an investment plan that has your portfolio and your goals aligned. So you're investing, in this case, aggressively enough to achieve your goals. All right, so we've got a question from John. Wouldn't interest rate increases benefit banks? Yes. Yes, so I obviously made a large generalization around interest rates. Interest rates going up do benefit certain companies. Overall, I think it's going to make the market go down, just because the expectation is that interest rates don't move. But yeah, no, banks are really struggling in this environment, and yeah, they would certainly not be opposed, I think, to an increase in interest rates. All right, anonymous attendee, our favorite attendee. Wow, Amy wrote a nice message. Amy, you can be our biggest fan. It used to be, who was it? It was Grant who kept asking nice questions. Lisa does ask questions. We were talking yesterday at lunch about going on a road trip to see Lisa. Yeah, we're not just going to show up unannounced, by the way, Lisa. But the anonymous attendee says, are you deleting things off of here? Okay. The anonymous attendee says, with fixed interest rates so low and even negative, would it be bad to invest in a bond fund now? Yeah, I think it would be. So once again, I'm not offering you any personal advice, but if we think about, so let's take a step back, and we're actually about to do a podcast episode. We'll tape it today on fixed interest because people are into that. They keep asking questions about it. So yeah, I think it's a really bad time probably to invest in a bond fund. So if we think about bonds and we think about where the return comes from in bonds, well, in general, if we just go buy a bond that we want to hold to maturity, so if we go buy an individual bond, you're really getting your return from one place. If you're holding it to maturity, you're getting it from the coupon payments that you're getting. Well, you're not getting any coupon payments now because interest rates are so low. And you can be, if inflation starts picking up, there's a pretty big worry that inflation is going to outstrip your returns if you lock in like a 10-year bond right now. The other place that people invest in fixed interest is they go out and they buy funds and ETFs. Now, funds and ETFs invest in a portfolio of bonds. They are continually sort of buying and selling bonds. So not only does the income you make, so the coupon payments from these portfolios of bonds matter to you, but also just the level of price of the bonds. Because anytime you exit that fund or ETF, you of course have to sell it for whatever price it is. So if you are doing that and interest rates, the driver of bond prices going up are interest rates going down. So they move inversely to interest rates. So yeah, now's a really bad time because even if interest rates don't go up, they're probably not going to go down, right? At the end of the day, there isn't much space for interest rates to go down. So there isn't a lot of opportunity for you to drive returns from falling interest rates from a bond perspective. So yeah, it's a pretty difficult time. So what I would do is go on to, if you're invested in an ETF or a bond fund, go on and find the duration. So duration will be a measure probably in like the portfolio characteristics page of a bond fund or ETF. Duration measures the degree of interest rate risk basically in a bond. So duration is measured generally in years, so they'll call it years. It's very confusing. But if you have a duration of 5, what that basically means is that if interest rates move 1% in either direction, the impact on that bond fund or ETF is estimated at 5%. So if interest rates go up 1%, your bond prices, your bond ETF or fund would go down 5%. So go check out duration. It's a good little measure. Are you deleting all of these off here? Okay, it's very confusing. All right, talking about risk. So this is a question from Luca. In an overvalued stock market like one seems right now, what could be a good strategy? Yeah, I mean, listen. It depends upon your personal circumstances. So of course, I will say that it really does depend upon what age you are. So if you are younger, and we've talked about this as examples before, if you're younger and you have a very long investment horizon, making decisions based on where the market is basically market timing. Now, I think the market's really overvalued, but if I had a 30-year time horizon to invest and I'm slowly putting money in with each paycheck, then yeah, I mean, it would probably take a lot for me to change my strategy. The question, of course, is what do you do if you are older, you have less of a time horizon? Sort of personally, what I've done is I have built up some cash, and I've done that just by turning off dividend reinvestment, and I've done that by just not investing as much of my own savings. I've just been keeping it more in cash just because I believe there will be opportunities to hopefully get securities at lower prices. But yeah, I mean, it's hard obviously to say what the strategy is. It is personal, Luca. So yeah, I would focus on your goals, focus on where you are compared to your goals, and go from there. All right, Lisa, who we were talking about before. Lisa says, how do we incorporate fixed interest and cash holdings along with our equities into our portfolio on the Morningstar Portfolio Manager? All right, well, that's a great question, Lisa. So there's a couple different ways you can do it. So we, as part of Morningstar Premium, you get access to ShareSite. So ShareSite is the portfolio manager that we use. So with ShareSite, there's a couple different things. If you invest in funds or ETFs that hold fixed interest, you can just put those directly in. The other thing you can do is you can just put in any sort of security. So basically a line and you can just call it cash and then put in a cash balance and then update that as you get cash in. So that's sort of the simple way to do that. John Turner said, whoopee. All right. You're more excited about this today than I am. Lisa says, Shani, we are welcome to come visit the alpacas. And Nino is the alpaca. So Lisa has 3 alpacas. Nino is the one that likes us the most, apparently. So I think if we show up and we don't know which alpaca is which, and 2 of them are spitting at us, Nino is probably the one that is least likely to be spitting at us. But Nino has a couple questions. Okay, so John says, I like the concept of ETFs, but what happens if the market tanks, the market that's covered by the ETF? If you want or need to sell, wouldn't you be selling into a bear market? Yeah, so the problem, the other episode that we're that we're recording today, we're doing 2, Will, by the way, as a birthday present for you. The other episode that we're recording today is looking at sort of passive investing. So one of the interesting things is passive investing has done very, very well since the GFC. And the reason it's done very well is just because the markets have done very well. So we're in this little bit of an interesting situation where when people invest passively, they're investing into market cap weighted indexes. So stocks that have done well continue to do well. So these large cap, a lot of them are technology companies, have continued to do well and become bigger and bigger parts of an index as more money's gotten shoveled in, and growth stocks have done very well. But yeah, the problem is on the other side. So yeah, if you have an ETF and it is a sort of significant bear market, of course it's going to go down because it's tracking the market. But also as there's more selling in these ETFs, if there's more passive selling, the opposite thing is going to happen. Once again, all these big companies that have done very well are probably going to get hit a lot harder, and yeah, potentially large cap growth stocks, which have done so well, could be hit probably harder. So we've got a question saying, what share site platform is included in the Morningstar subscription? Starter versus investor versus expert. So investor. So ShareSite has a couple different, and ShareSite is a third-party portfolio tracking tool. They've got a couple plans. So they've got a starter plan, which is our free plan. You have 1 portfolio and 10 securities in it. Then they've got the investor plan, which you get as part of Morningstar Premium. You get 3 portfolios and unlimited securities. And then you have the expert plan. So the expert plan we don't cover. But if you do want to get the expert plan, did you just raise your hand, Will? If you want to get the expert plan, Will's thinking about his lawn. If you want to get the expert plan, we will pay for the investor plan and you just pay the difference. And that expert plan will work with Morningstar Premium. So we will bring in all those portfolios. So I think it's 5 portfolios for expert. We'll bring those all into Morningstar Premium. Okay, Chris says, is there any way to see these webinars again? Oh, geez. Yeah. You can, Chris. So we have a YouTube channel that we're now posting them all on. So all you have to do is Google Morningstar Australia YouTube, and then there's a playlist for all of these webinars. So if you have, I don't know, if you're having a horrible day and want to just watch me spout off about God knows what over and over again, you can go onto YouTube and watch them. And people are commenting on our YouTube, Will. We're getting one person said something nice, and then I think nobody else, but it was good. So Chris, yeah, go onto YouTube. If you need the link, you can just email me at mark.lamonica1@morningstar.com. All right. Thank you. So, yeah, hopefully you're in a bad Wi-Fi zone because you're doing something fun. All right, now we have, let's see if there's anything in the chat except for Shani insulting me. Somebody said they love ShareSite. Yeah, we like ShareSite too. Yeah, I don't know what else I'm supposed to say about that. The Doug Morris, who is the CEO of ShareSite, used to work at Morningstar. Oh, Chris is in quarantine. Captive audience. I'm sorry, Chris. I have friends in quarantine. They get out Sunday, so they're really excited. Anonymous attendee said you talked about podcasts earlier. Where are they? Our podcasts are better than the webinars because Shani's on it. And Shani is better at this stuff than me. And it's called Investing Compass. It's available on everywhere you would find a podcast. So it's on Spotify. It's on Apple Podcasts. We also have a link on our website. So if you go on our website and look in the upper right-hand corner, we've got this like embedded player within our website. So yeah, the podcast is available. Will's sending through the YouTube channel. All right, fun times. Okay. I think we're going to finish early. Is everyone excited about that? Yep. Okay, so if anyone has any questions, please email me. So mark.lamonica1@morningstar.com. Yeah, I hope everyone enjoyed today. We'll have a little more comprehensive one on Tuesday with our spreadsheets and everything else. Good luck in quarantine, Chris. I hope you got a good hotel, although the fact that you have bad Wi-Fi is not a good indication of that. And yeah, hopefully you get out soon. All right, thanks, guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.